Hey everyone, welcome back to Corporate Decoder, the place where we take boring financial documents and find out if a company is secretly building a rocket ship or just spinning its wheels. Today we are diving into Columbus Circle Capital Corp, the SUD. And let me tell you, this company has a plan to let its shareholders start trading pieces of their investment separately. It sounds a bit like a company that might be preparing for some big moves. So what is the big deal? Well, Columbus Circle Capital Corp, the SUG, or the company as they call themselves, has announced that starting soon, holders of their units will be able to split them up. Think of a unit like a bundle that comes with one share of the company's stock and a little extra piece, a warrant. These units have been trading under the ticker symbol CMU, but soon the individual shares, called Class A ordinary shares, will trade under CME, and the warrants will trade under CMU. This is a pretty common move for companies that have recently gone public, and it gives investors more flexibility. So in simple terms, if you bought one of these units, you currently have a package deal, but starting the 27th of February 2026, you can ask your broker to break that package open. You'll get a share of stock and a warrant, and you can then decide to hold on to them, sell them, or use the warrants to buy more shares at a set price. And what about those warrants? Each whole warrant can be used to buy one Class A ordinary share for $11.5. This tells us the company expects its stock price to go up, because why would anyone use a warrant to buy a share for $11.5 if the market price was lower than that? It is a way for the company to potentially raise more money down the line if these warrants get exercised. All of these separate pieces, the units, the shares, and the warrants, are being traded on the Nasdaq Stock Market LLC. That is a pretty well-known exchange, so it suggests a certain level of transparency and oversight. Now, interesting fact here is that Columbus Circle Capital Corp II has declared itself an emerging growth company. This means they are a relatively new company and can take advantage of some regulatory flexibilities. It also means they haven't elected to use the extended transition period for complying with new or revised financial accounting standards, meaning they are keeping up with the latest financial reporting rules, which is a good sign for transparency. This whole announcement is basically a formal notification to the public and the market that this separation of trading is happening. It is not a report with deep financial numbers that tell us how the company is actually performing in terms of revenue or profit, but it is a crucial step in how the company's securities are traded and perceived in the market. It is more about the structure of their stock and what investors can do with it. So let's sum up the strategy here. By allowing separate trading, Columbus Circle Capital Corp, the SU, is making its pieces more attractive to different types of investors. Some might want just the stock to participate in potential growth, while others might be interested in the warrants as a way to bet on future stock price appreciation with less upfront cost. It is a smart move to potentially increase liquidity and investor interest in their offerings. Now, looking at the bigger picture, what does this mean for the company and its investors? This filing doesn't give us profit and loss figures, so we can't do a deep dive into their financial health like we usually love to do. However, the fact that they are allowing these separate trades suggests they are confident in the value of their underlying Class A ordinary shares and the future potential of their warrants. It is a vote of confidence in a way, allowing investors to pick and choose the parts of the investment they like best. The main risk here, if you can call it that, is that separating the units could lead to more volatility. If the warrants are heavily traded and their price fluctuates wildly, it could indirectly affect the share price of the Class A ordinary shares. On the other hand, it offers a clearer way for investors to understand the separate value drivers of the company's securities. In conclusion, Columbus Circle Capital Corp, the SUG, is making a strategic move to enhance the trading flexibility of its securities. While this particular filing doesn't reveal financial performance metrics, the decision to allow separate trading of shares and warrants signals confidence and aims to attract a broader range of investors. It is a positive step for market liquidity and investor choice. Alright, that is our breakdown of Columbus Circle Capital Corp IC's latest announcement. What is your take on this move to separate their units into shares and warrants? Do you see it as a clever way to boost interest or just a standard procedure? Drop your thoughts in the comments below. If this clear explanation of financial events was valuable, hitting that like button really helps us out, and subscribe so you don't miss our next deep dive. And hey, don't forget to check out our Discord server linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.